The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Small Business Tuesday continues with Your Money, Your Call.
Welcome to Your Money, Your Call. It's Tuesday night and it's your share night. It's a normal show apart from one slightly different thing tonight. During the program we'll be taking you live around 8:30 p.m. to Melbourne for the Q&A session with RBA Governor Philip Lowe following his keynote address at the CEDA 2016 annual dinner. So something a little bit different. But before we do, and after that as well, we'll be taking your calls and answering your emails. So if you've got a question about shares, our phone line is 1300 30 34 35 and the email address is yourmoney@skynews.com.au, and we hope you'll get through to us quickly to get those questions coming. The panel tonight consists of Richard Hemming from Under the Radar and Carl Capolingua from Investor Systems. Welcome to the program. It's been a busy time on the market. It's been a big story for equities, but certainly the main games of the bond market. We've seen a very pronounced sell-off. I guess everybody knew at some stage it was going to come, but November 2016, it's alive. Carl, what do you make of it all?
Yeah, look, I didn't have it on my calendar marked for exactly November 2016. You're right, it was the elephant in the room for such a long time, wasn't it? And historically, there's a very strong relationship, or I guess counter relationship between the bond market and the stock market. And typically when bond yields are rising, that is typically not good for the stock market because of comparative valuation. So bonds typically considered, high quality government bonds like US bonds and our Australian bonds, considered to be quite risk-free investments. Yeah. And in the US you're currently getting around about 2.3% on those benchmark 10 years. In Australia about 2.6%. Compare that to the sort of average yield on the Aussie market of about 4 to 4.5%.
Okay, I'll just stop you there. Sorry, Carl. I don't think we've got a mic on you, so we might be missing all of that brilliance that we've just provided. Yeah. But Richard, just interpreting that.
I can interpret.
So broadly, what we're saying here is there's been such a profound move following the move in bond markets against equities, but it's not evenly distributed, is it, Richard?
Well, I think, like somebody once said in politics, it's exciting times, and certainly exciting times at the moment. I think there's a big relief rally going on, certainly, and I think if you were to ask anyone what's going to happen, I think anyone would be lying if they could tell you that they know what's going to happen. But definitely I think there are inflationary expectations, so there's been a steepening of the yield curve, which people are saying, well, that's a good thing. And quite frankly, if it does happen, if pressure's taken off monetary policy and moved towards fiscal policy, that's a big positive. But there's a lot of, skeptics out there, and I guess I'm one of them. Like, we've had a sort of expansionist guy in the White House for the past 8 years, and he hasn't been able to get anything through a kind of a small government orientated Congress. So I guess you've got to be sceptical is what I'm trying to say, but there's definitely a relief rally going on. It's going to be like really stock by stock, I guess. That's how we look at the market, stock by stock. Right. And I think that's what this show's all about, isn't it, Jeremy?
Definitely.
That's why we're here.
That's why we're here.
Let's get fired up.
Tough questions. And before we go to our first tough question, we'll come back to you, Carl, because we didn't hear your answer them before. But just broadly, your take on the market with these big swings happening there.
Look, I think the market is in the same holding pattern that it's been in now for well over 12 months. I think there are too many global macroeconomic headwinds to get any clear run to the upside, and every now and then one of those just comes and just niggles at investor confidence and knocks us down again. So I can't see much of a change in the near term. Obviously things are always changing, so I reserve the right to change my mind before my next appearance, but until then more of the status quo.
Excellent, thanks for that, Carl, and thanks to you, Richard. As we go to that first question, which has arrived via email, and reminding you of the number to call us on to get your questions through before and after Philip Lowe's Q&A session tonight. Mark has emailed in to the panel. I would like the panel's view on Aconex ACX. It's been dropping lately. Could someone tell me what the resistance level is for Aconex and what is the panel's view on buying it? We thank Mark for his email. Aconex has been an outstanding performer over the last year or so. It's a recent listing, really. It's only been listed less than 2 years, but it fell quite sharply today. It's had big moves most days either way, and today I think the CFO resigned, so that might have been accompanying that news. But more broadly, on Mark's question there, Carl, how do you see Aconex?
Yeah, look, I'll tackle it from a technical perspective. It's not one that is on the scans at the moment for me to do any further work on the fundamentals, so I'll just stick with the technicals, and they don't look very good at the moment. Fantastic stock through till about August, September. I'm just looking at my chart here. We had a sell signal late September. It's still in a sell phase. That means from a probability standpoint, it's more likely, based upon my models, to continue to fall from here than it is to rise. I think the question was more about downside targets and maybe when there might be a buy point into this. That's really the opposite of my style. I don't like to try and catch the falling sword, which this one is. It's in free fall today, falling below $5. So it's not my style, but if I had to put a number on it, it'd be sub-4, probably around about 380. But if you're going to try and play that game, I'd strongly recommend that you wait for some sort of bounce first before you try and get in. Don't try and pick that bottom. Wait for some positive momentum before you try and buy it. Yeah, 380, I think.
Yeah, okay, interesting. Thanks, Carl. Thanks for your email, Mark. Our caller on the line now is Ben, who's calling from Brisbane. Good evening to you, Ben.
Yeah, good evening. Could I just get a technical off Carl on TSN? And Jeremy, if you would be able to give me your opinion on Nine Entertainment, whether you think they can hold these dividends for the short term?
Okay, excellent, yeah. Thanks for your call, Ben. Let's go to Carl and have a look at TSM, which is Transactions Solutions. Have you got a chart up on that, Carl?
Working on it. Here we go.
Working on it? Good man.
Yeah, look, and the reason why I say I'm working on it, it's not one that springs to mind, so it hasn't come up on the scans. Lately, for the people that haven't seen me on the show, I'm mostly technical analysis, and the methodology is to run my technical scans. There's over 2,500 stocks in the Australian market. It's impossible to look at the fundamentals of all of them. So we've devised some algorithmic-based technical scans purely on price action and volume. That narrows that list down from 2,500 to a couple of dozen typically on any day of the week, and then it's my job to go through that short list and look at the fundamentals and find the stocks that I guess have nice price momentum, but also have a reasonable valuation. That's important for me. Evidence of or a history, 2 to 3 years at least, track record of earnings growth, typically double digit. Preferred there, and the ability at least to pay a dividend yield. So straight up, this is not one that I've looked at from that perspective, so I'll comment strictly on the technicals. Technicals aren't that bad. I can see a pretty good short-term trend. Medium-term trend's pretty flat, long-term trend up. What I do like about the stock is it's built quite a substantial base pattern between that sort of 2 and 2.5 cent level, so straight away you can tell it's a bit more of a speculative stock than one for your long-term super fund perhaps. But I do believe that if it can get back above 3, we see a little bit of volume coming in here, which is evidence on the chart now, then it is prospective for a move to 4. Could spend some time there, and if I'm on the show when it's at 4, ask me again next time. So yeah, I can see 4 cents in the short to medium term, and on a break of that really could be anything, but let's see how it behaves at 4 first.
Great, thanks for that, Carl, and thanks for your call, Ben. Our next caller on the line is Andrew, who's also from Brisbane. Good evening, Andrew.
Oh, good morning, Jeremy. Afternoon.
I think it's evening. Yeah, okay.
Evening. Oh, look, it's a great panel tonight. I just have a couple questions. The first one is about SDI.
Yes.
It's a dental company.
Yes.
And the second one is PGC. It's in the healthcare, I believe. I'm just particularly interested in both of these in terms of a technical and fundamental view. Thanks very much.
Yeah, great. Thanks for your call, Andrew. SDI was Southern Dental. It was the one that did amalgams and what have you for dental services. It had to change its business markedly as materials in the dentistry business changed. it has begun to perform quite well. Carl, I might get a technical comment on SDI before we go to the break and look at Paragon Health after the break.
Okay.
SDI, Carl.
As you can see on screen right now, the chart looks quite good actually, and I think the chart's mirroring those fundamentals. I can't fault really the technicals at this stage. The only question is, how does it deal with a dollar? Big round number there. It popped through it quite easily back in October. I'd like to see it hold this level and start to move back up towards those highs before I went into it. But look, I think from a technical perspective, it's outperforming the broader market. Strong trends, strong price action. From a fundamental perspective, I think the fundamentals back up the technicals here. It's got good earnings growth. It's grown its revenue consistently. In terms of earnings growth, it did have a bit of a miss a couple of years ago, but underlying revenues growing well, net operating cash flows growing well. It's got a reasonable dividend yield, so it ticks most of the boxes for me. Happy to be a buyer, as I said, probably through 110 to 115.
Great. Thanks, Carl. There, Andrew. We've got SDI. We're going to go to a break and come back, Andrew, for your question on Paragon Health. If you'd like to speak to the panel, the number to call on is 1300 30 34 35. We'll be back soon. Welcome back to Your Money, Your Call. We're still taking your calls on 1300 30 34 35 and your emails, yourmoney@skynews.com.au. Well, we're going to the break with a question that Andrew had about PGC, which is Paragon Health. So we'll go to Carl and ask him to give us a technical on that one, or any information he can provide to help Andrew.
Sure. It looks great. It's a great-looking chart from a technical perspective. It's way ahead of the broader market, so I'm a big believer in relative strength in stocks. When I say relative strength, I don't mean that classic RSI indicator that's on everybody's technical analysis package. I mean relative strength comparison. Or comparative with the market. So basically you're comparing the performance of the stock, price performance of the stock, against the price performance of the sector or the index within which it sits. So my belief is that the fund managers like to rotate into and out of stocks, into and out of sectors, and I like to therefore buy stocks that are outperforming the broader market. They're the ones that the fund managers are buying, and preferably also that sector is doing well. Healthcare sector not doing that fantastic at the moment. It's probably flat with the market, but there are some good buys, I think, within the sector. This, I think, is one of them. As I said, outperforming the broader market. All three of the key trends that I look at, short-term, medium-term trends, all strongly up. It's built a really great base pattern here around about that 80 to 90 cents, and if we can get through that 90, I think $1 is an obvious target, but anywhere from there. So I think it's a good medium to long-term investment here. I don't think there's any hurry to get in right now. Look for a break of that 90. If I could offer one very, very similar space, probably really sharing this space, that I think is slightly more prospective, it's LHC, which is Life Healthcare Group, and I think it just beats out this one just in terms of more consistent earnings growth, better earnings growth, and the dividend yield's about double. So if you're looking for a bit of a yield play as well, I think LHC is probably the better way to go, but I don't think you can do too far wrong with either of those stocks right now.
Good one, Carl. Thanks for that. Our next caller's on the line. It's Rosie from Queensland. Good evening, Rosie.
Good evening, and hello to the panel as well. I'm interested in the panel's view on Evolution Mining. It's come down a little bit, and we're thinking of getting into it at around $2.
Okay, yeah, great. And I'll go to you now, Carl. What is that? You're a bit bearish?
Yeah, look, more cautious, I think, is the right word. From memory, the question was about whether the caller should get into it. I'm sorry, I can't remember her name. I don't think it's time to get into it. In fact, we've just had a sell signal on this stock just yesterday, and that's after a period of about 18 months of it being in a buy phase. So we had the buy signal on 6th of May 2015 as it broke through $1, and it's been in a solid buy phase all of that time, literally until yesterday. The balance of probability therefore suggests that there are further falls ahead. I'm not going to speculate at this stage where those falls could take it. There is some technical support around 150, but too early to tell. So I'd be really cautious about entering EVN in the short to medium term, given what the model's saying at this stage.
Great, thanks, Carl. Now, Dave's emailed the panel tonight, and Dave has asked, what's the panel's opinion on IVE Group? Code is IGL. I have viewed their reports and balance sheets, and everything seems to be pointing forward without much price movement. Thanks for your email, Dave. IGL. Carl, how do you see it technically?
Look, technically it doesn't look fantastic at all. I think it's suffering from a lack of information, lack of clarity. It's a relatively new stock, so it's had one report out and, 2 points makes a line and 2 points makes a trend. So I think until, fund managers can see a bit of a track record on this one, you're probably not going to see as much or enough interest, I should say, for demand to substantially outweigh supply and therefore the price to increase. I mean, looking at it from a fundamental perspective, it ticks a lot of boxes, as you said, as the caller said, a strong balance sheet, it's reasonably priced, single-digit PE. It's hard for me to do the analysis I need to do and say, okay, well, what's the earnings growth? Yes, it's got a 7% dividend yield, but what's the trend? So if I can't do the analysis, I'm getting a lot of the other fund managers out there can't do the analysis. And if we're not analysing a stock, we've got no interest in it. We're not applying any money to it. So I think that's where it's at right now. So I think you're probably going to have to look at this another 6 months' time and see if there's some sort of trend developing either on the chart side or the fundamental side. So it's a pass for me.
Good one. Thanks, Carl, and thanks, Dave, for your email. We've got a caller on the line. James called in from Sydney tonight. Good evening, James.
Good evening, gentlemen. Thank you for taking my call. I'd like to know about Sydney Airport. The price has come down a bit.
Yeah.
And why has this happened? And what's the future for Sydney Airport?
Yeah, great. Thanks for your call, James. I think it's a really good one at a time when the growth in the passenger numbers and therefore revenue is moving up very, very strongly at the moment. It's clearly a great destination point. But the answer will come back more to the debt side of things, and with 7 times debt to EBITDA, it's going to be that way. Now, talk to us about
hard work,
this.
seven times.
Yeah. So it's about, a bit under $6. It was over $7 quite strongly some time ago. Carl.
Yeah, look, I agree with comments of both of you gentlemen here, and TCL. I think if you've got Sydney Airports in your portfolio, you've probably got TCL in there as well. It's a very similar theme. Obviously, I agree with bond yields. I think in the case of Sydney Airports, it is priced a little bit for perfection as well. I mean, it ticks a lot of boxes, as you say, great growth prospects, and it's delivered, but it is priced at 30-something times earnings, and I think it got to be a very crowded trade, and there's just fewer of those exciting things about it for the fundies right now, and we're seeing a crowded trade being unwound. I think the most important thing you said was there'll be a time for it. I believe so as well, and I just don't think the time is now. So let's just wait and see on this one.
Yeah, great. Appreciate your call, James. Andy's on the line, calling from Brisbane. Andy, are you with us tonight?
Yes. Hi, panel. Looking at Domino's, it's had a wild run the last couple of weeks. It's gone from close to 80 back. 60 back to 80, and now it's settled in the middle of the range. So I'm just wondering whether we'll test the 60 barrier again.
Yeah, no, good question there, Andy, and it's certainly been a wild ride. It was sold down with a lot of other high growth, high PE stocks over the last month, but last week's AGM and reformation of their earnings guidance, in fact, an upgrade to their earnings outlook, saw the stock move up again. And I'm going to go to Carl, and Carl, this has trended pretty well over a long period of time, but
yes,
that nexus is broken a bit now. How does it look?
I wish I could get my chart on the screen right now. So Domino's has been a wonderful performer. It's been such a consistent, strong trend. It's been a great performer for us. Our buy signal came in late 2009, and it's been a consistent buy signal for that entire time. Having said that, I'll just find the exact day here that it switched to a sell signal. So this is looking at the date here. It was the 2nd of this month. So for the first time in over 6 years, nearly 7 years, this has become a sell signal for us. So again, the balance of probability based upon our models suggests that there is more downside on this one than upside. The maths behind me coming to that conclusion is substantial. So all I will say is the model said sell on the 2nd, and the model's right more often than not. So I think if you've had a great run on Domino's, now's the time. It's a great time to get some profits off the table.
Yeah, great. Thanks for that, Carl. Our next caller's on the line. We've got Nick who's called in. Nick is from Melbourne. Good evening, Nick.
Oh, good evening, panel. How are you going? I'm calling about TPG Telecom. I've been looking for a decent entry signal, and it seems to be, I know it looks to be bottoming out around the $7 region. Do you guys think it has bottomed out, and is there any more downside?
Yeah, good. Thanks for your call, Nick. Another stock that probably got loved too much. Over $12, multiples were high. $7 I like. Technically, how does it look to you there, Carl, before a break?
7, 6 or 5. So 7 best case scenario, that's where it is right now. Yeah. 6 probably more probable scenario. 5 worst case scenario. It's just not my game to try and pick a bottom on these things. Yeah. I think there are better opportunities out in the market and better strategies than this. So my honest opinion is, don't buy this one. Yeah. But if you have to,
falling knife, is that what you're saying?
It is. There's better strategies out there than this. It might work every now and then, and you'll look like a hero, but more often than not, it won't work for you.
Good one. Thanks for that, Carl and Richard. We're going to a break now, but after this break, we'll be back with more of your questions. We've got that number on the screen there, 1300 30 34 35. That's the one to call us on to get through to the panel. See you in a moment. Welcome back to the program. If you've got a question about shares, our phone lines are open. It's 1300 30 34 35 or email yourmoney@skynews.com.au. Well, we've got a caller on the line. It's Michael, who's called in from Melbourne. Good evening, Michael.
Yeah, good evening. Query on Money3.
Yes.
MNY. They've rocked up quite a lot since June. They had a boardroom spat earlier in the year, and Westpac withdrew a $30 million facility, but things seem to be going well now.
Yeah.
Thorney Investments are a major shareholder and helping bankroll them until they can get permanent finance. Be interested in your comments on them.
Yeah, certainly, Michael. Good having the Pratt family behind you. That's always been helpful. MNY is the stock code. Carl?
Yep.
How do you see this one? Has it recovered a bit?
Yeah, look, I like the stock. Technicals are a little bit iffy here. It's come back from $2, challenging $2, couldn't quite make it back to $1.50, so decent drop there, and sort of sitting in the middle right now. I think that's a reaction to the January 15, February 15 high. Fairly natural to see that when stocks try and challenge those old highs. The key is how it responds from here. It's not ideal. It's not ideal price action, so I'd be a little bit cautious. It's a stock that I've been watching for a while, so I know it pretty well. I know the fundamentals are good in this. I'm just waiting for the buy signal. So it's very well priced. It's got good growth, and it's a very consistent performer. So it's one where you can have a great stock. So it's one thing to have a great stock, but for me, it's about getting it at the right time. I'm just not sure it's the right time from the technical. So it's a watch for me.
Good one. Thanks, Carl. So Carl likes Money3, but just maybe not at this price. Our next caller's on the line. We've got Paul, who's from the great state of New South Wales. Good evening, Paul.
Good evening. Thanks very much for taking my call. Gentlemen, I was just after a technical and a fundamental on junior iron ore that had been beaten up over the recent years, Atlas Iron AGO. Thank you very much.
Great. Thanks, Paul, for your call. Atlas Iron, in the good old days of iron ore, one of the really high flyers, but gee, struggled to survive really through the dips. But how does it look now for you, Carl? Iron ore, obviously, tonight coming off after a pronounced run-up. I think it's up around about 50% for the calendar year. And over $80 a tonne.
$80
was on Friday night, but it's lost 8% in 2 trading days so far. So it is coming back. There's a lot of activity in the futures market for iron ore, which is probably distorting it somewhat. Debt in a cyclical environment can be always a problem. They had net cash at one point, but they found a way to spend it.
Sure, and interest rates on the rise as well.
Yeah, and they're looking better. They're going up. That's a good thing.
It's a pure spec play. Yeah. There's nothing else to say about it. And then putting my sensible hat away here and adopting just my punting my brains out hat.
You're at the track.
Yeah, look, there's something going on here. Definitely there's some interest in the stock. There's been some movement at the station, and that's usually the first sign that there's potentially some more upside to the stock. But
Has there been much volume through?
yeah, look, absolutely. I mean, a massive wave of volume has hit. So that often there's so much dead wood in these stocks. I mean, this stock is one of the worst performing mining stocks of the boom and the bust phase, all included. And there's a lot of dead. There's a lot of people just waiting for any sort of bounce to get anything out of it. So the only way you can get rid of that dead wood is to trade with them.
Yeah.
And the only way you can trade with them is to see money coming in. That's volume. Evidenced by volume and changing hands. Once the new hands come in, they're at the low price, they're looking at higher prices. It can happen, but I've wasted way too much time talking about AGO because it's not a stock I would buy right now. But hey, if it gets to 10 cents, good luck to you.
Good luck to you indeed. Well, that's all we've got time for on the show tonight. Thanks so much to our guests, Richard Hemming from Under the Radar and Carl Capolingua from Investor Systems. And to you, all our viewers, thanks for your calls and thanks for your emails. They make the show. That's all we've got time for. If you want, though, to catch up on anything more, you will find that on the favourite podcast platform and search for Sky News, Your Money, Your Call. Until next time, I'm Jeremy Hook from TMS Capital. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.